If you're planning on running the next revolutionary business, sooner or later you're going to need some funding. Perhaps you've looked into how companies get funded and you're confused by some of the financial ease. Well, worry no more. Today, we're going to be diving into two of the most commonly discussed types of funding and sorting out the differences between them so you can talk business with the top investors the world over. This is the who, what, when, and how of private equity and venture capital. What do they have in common? Both private equity and venture capital are forms of private investment, where the companies are not publicly traded on the stock market. Like all investments, they both involve the exchange of a substantial sum of money for partial or total ownership of a business. The company receives a much-needed influx of capital for the business, and the investor hopes to see a return from their investment. How are they different? Private equity and venture capital differ in the types, sizes, and ages of the businesses they invest in, as well as how much money they invest, how much equity they acquire, and how involved the investors get with the decisions of the company during the investment period. Let's start with private equity. Private equity is reserved for only the most established, most stable companies in the world. Investors buy into established companies that may be experiencing hardships or not returning profits to their full potential, with a goal to streamline their operations, rejuvenate the company, and increase revenue. They typically buy full ownership of a company in what's called a leveraged buyout, thereby giving them total control of the business. Their investment is concentrated into one company, as there is little chance of an absolute loss on an already established business. This buyout usually involves a substantial amount of money, with buyouts reaching tens, hundreds, or even billions of dollars. But it's not all about who can put up the most cash. Private equity is about management as well. Venture capital investors put their money into newer, less established businesses with a view to make above-average returns on their investment once the company delivers on its potential. These investments are much smaller than private equity invests for large companies who are established but are struggling to hold the same power they had before. An investment company will often buy a controlling or complete share of the company at a hefty price and will sell their shares in the company once they've turned the business around. Venture capital is for smaller companies who are newly established and need an influx of cash to make that next big step. Investment in these companies is less about control and more about return, leveraging a small investment into a big payday when it comes time to go public. Investors often play a mentor role rather than an executive one and can provide valuable experience to the founders without needing to steer the business themselves. Now that you understand the ins and outs of private equity and venture capital, it's time to put your knowledge to good use. You can now confidently discuss investment with other entrepreneurs, identify and negotiate the right type of funding for your business, and one day, maybe even become an investor yourself.